Then I'm sure Blake will take it to this next degree. That's when starting to invest in front-loaded depreciable assets such as mobile home parks starts to become so advantageous for someone who's trying to lower their tax load as well as generate net worth and cash flow.
Exactly.
As well, passive cash flow to then help, sustain income while you're still working, but then hopefully get to the other side of the hill when you hang up the boots to then be able to live off of that passive cash flow. And then maybe you have a double whammy where you're able to sell that business at some point and you have some excess, liquidity or capital to then decide which you want to, what you want to do with that. We could start to talk about that. But that's really like the magic right there is if you own a business, you own rentals, your wife qualifies as a real estate professional, you've kind of have set yourself up to where investing in our space or really investing in any real estate becomes a no-brainer. And let me just put numbers behind exactly what I mean by this.
Yeah.
So say you qualify as a real estate professional and let's use that the big, beautiful bill does pass and the 100% bonus comes back.
Yes.
Say you invest $1 million into one of our deals or any other mobile home park, right? You buy your own. It doesn't have to be with us.
And you do a cost segregation
study.
And
you do a cost segregation study, and we could talk about what that is.
Yep.
Should.
Simple math is that you're going to get, if it's 100% bonus on your K1, and just having done this for a long time can back it up with facts, you should get about a 1-to-1 loss. So on $1 million investment, you'll get $1 million in year one losses. And I could talk through why that is. But if on $1 million investment, you'll get $1 million year one losses, which is just startles people. They're like, that wait, Ben, how do you get that? And then I back into exactly how that happens. So say you invest $1 million into an asset that is paying you a 5% cash flow starting, and it's going to generate let's just do conservative 15 overall return. So you're getting 10% of overall appreciation per year. In 10 years, that $1 million will be worth $2 million, right? And let's just say it's 5% for the duration for easy math. Yeah. Sure. So there's 50%, 5 times 10, that's 50%. So you made $500,000 cash flow during that time, to which you pay no taxes on because of depreciation. But let's go back to this year, right? 2025. When you gave your CPA that $1 million of year one losses, that just saved you, let's just say like a 40% tax bracket, right? Like, or we could do 30, a third. It doesn't really matter.
$300,000 to $400,000.
Yeah, $300,000 to $400,000 you just saved on your taxes.
And if you don't use it all in that 1 year, it holds, and what they call it loss carry forward. So if you get a $300,000 savings on taxable income, and you only need to use 100 of it, then 200,000 of the 300 is going to hold on your tax return for the following tax year to cover next year's taxes. Now, passive income, which is different. However, when you're a real estate professional and have the designation, whether it doesn't have to be both husband and wife, it has to be one of the two, it will cover and shelter ordinary income and passive income. Which is the magic and why we love the real estate professional election so much, because it covers both types of income.
And then to sprinkle a little more magic on the second year. So on loss carry forward, if you don't use all, like let's say your net wasn't $1 million, like you had the $1 million to invest, but you really only needed to shelter $500,000 in income that year. Now you've offset that, but now you carry forward $500,000 into the next year. Well, that next year loss carry forward can offset California and capital gains.
Yes, it can.
So there's a longer term, as you get further and further into this, there's a reason to sort of intentionally store passive losses into the future years.
Especially if you know you're going to sell a house or do something
business,
that's going to
well, let's just unpack
tax.
Let's just unpack that just for some clarity, because you said capital gains, and sometimes people, I don't want to confuse what you're talking about to selling another investment property and creating capital gains, right? So what Blake's talking about is this loophole in the tax strategy where if you use carry forward depreciation, you could if you're a real estate professional, wash stock gain, So capital gains on, say,
or the sale of a property,
or
but
the
capital
sale
gains.
of a property. But I think where the magic comes in is the California taxes.
Yep.
And then it's the stock gain, right?
Is it stock, bond, treasuries, like any of those that spit out?
Well, it's
like,
capital gains on a sale of a stock, which
has a gain. Any gain that you make in a stock then is taxable when you pull it out. And this type of loss would shelter that type of income.
Because we're in California, it would also help with that gain in California, 13%.
Right.
It's most of us are having a hard time dodging.
And that strategy right there, that's like 3.0, right? And so when I first heard that, and I was, obviously speaking with the CPAs about it, that is, that takes some planning, right? That's 2 years of planning, or at least, it's roughly about 2 years. It's 2 tax returns of planning that you need to then plan. So say, I'll give you an example where this can make sense, because this is a real example. I have a buddy who works for SpaceX, right? Gets a lot of stock options.
Yeah.
And he has to pay taxes on those stock options, regardless if he sells it or anything. Just holding it.
Pre-IPO, they incur gains and have to pay taxes just as the stock price steps up in value.
Exactly.
Like appraised value, or however that.
Exactly.
Yeah.
And they're
heard that?
Oh, I
it's
didn't
horrible.
realize
it's terrible.
that.
Yeah. These are gains that you haven't even realized that you pay taxes
on unrealized gains.
Correct.
Wasn't that like a huge controversy with the Harris administration?
But that's regular stock exchange stock. What you're talking about is like, you own Tesla on the New York Stock Exchange, and then it goes up and you're paying taxes on that increase, even though you didn't sell.
Right.
But pre-IPO, it's always been that.
Yes.
Oh, that's terrible.
Okay, wait. So if you're paying pre-IPO taxes and you sell and there is a gain, is there no tax because you've already paid the gain? Or is the gain on the difference then from what they valued it to what you sold?
Well, it's hard to sell, because you're pre-IPO.
Okay.
But there are these newer things, because I've looked into buying SpaceX because I think it's interesting.
Fun. Yeah.
And but it's this big runaround, and you go through a private exchange. You have to be accredited. It's a whole thing. So I'm sure when you sell, if you've already paid the tax at that price point, then sure. But it's at what the sale price is.
This was the problem that was brought up, right? And I'm talking, and I'm like, well, you guys own a rental? Yeah. And I was like, okay, well, and they're having their first kid. And I was like, the wife was also working, good friend of mine as well. I was like, well, I don't know a lot about it, but I'll connect you with someone, a CPA that could chat with you about it to get you guys on the plan. If you're thinking about her being the stay-at-home mom and she's a real estate person as well. So she would love like just managing all their deals. Personally, you keep working, and then you could qualify for the real estate professional, right? And then start to invest in our deals. And then you could don't utilize the depreciation in year 1, carry forward into year 2. And then as he sells stock, use that to then wash the gain.
Right. Which, to your point, I just want to add something really quick, is you don't have to use the losses, right? You
Correct.
just said you can hold them and move them to the second year or third year.
Here's the planning. You buy an asset in 2025. You don't utilize the depreciation in 2025.
Let's say you borrowed money to buy that asset.
Correct.
Yep.
Now you don't really have anything to wash.
Well, then you buy the asset in 2025, you incur the loss, you carry it forward into 2026.
Yeah.
You sell the stock in 2026. You need to be a real estate professional for 2025 and 2026. You sell the stock in 2026. You use 2025 losses for your 2026 tax return. That's it. That's exactly the planning that I was talking about, which is multi-year.
Well, and if you bought something in 25, then you wouldn't necessarily need the losses. So then they could carry forward if you weren't able to save them. But I thought there was a way you wouldn't. The only
way to kick them forward is you don't need them.
I think.
It's just a calculation.
Yeah.
I'm almost positive.
People want to use them to minimize the taxes.
So like if you had if you were a real estate professional and you had a lot of gain, but then you wouldn't want to trigger gains that year. If you were starting from scratch and you knew the variables, like sometimes you get hit where you don't have control of a couple of variables and you end up with a gain. But if you had control, ideally you'd like find other sources of capital, you borrow the money, whatever, buy that real estate asset or invest in a deal like ours to incur that depreciation, passive losses in the year before you have a gain.
Right.
to his point.
Yep.
But yeah, I don't think you can make decisions.
Yeah,
It's
okay, that
more
makes
about
sense.
like when things hit and become, when they're placed into service,
Gotcha.
you know,
that makes
whether
sense.
you sell or buy or whatever.
Right.
Yeah, now we're going pretty deep, and it's like I just wanted to put another disclosure out there. We're not CPAs, financial advisors.
But
We're just throwing.
We have really great CPAs, and we don't pay a lot of tax.
A lot of this is just chatting through ideas.
Yeah.
Brainstorming. We're business owners and operators, and we're conveying this to other business owners and operators. What do you, sometimes, I mean, I think it's funny. Occasionally we bump into people and they aren't even thinking about taxes at all, right? They're just working, they're crushing it, and they're getting hammered at the end of the year. And they're like, gosh, that really sucks. Once a year, my life sucks.
Yeah. How do I
I've
not do that and not pay taxes?
It's not like a huge number, but I've had conversations with people. I'm like, what? So are you paying tax? It's like, well, yeah, but we don't look at investments based on taxes.
Yeah,
well,
I've
you
heard
paying a
that
lot of
too.
tax or
You
not?
should.
Yeah.
You know, like
Yeah.
it's kind of a yes or no question. If you're paying a lot of taxes, then there's obviously some strategy. Not saying you should go all in on a given strategy. There's probably a strategy that you could start to reduce taxes,
Right.
but also earn revenue and have a real asset that pays you cash flow that's tax efficient.
Okay. So
We're not going to look at that tax benefit.
We go for 30% IRRs only.
I think we circle back because
And
we
pay
were talking
15%
about
taxes on it.
depreciation and cost segregation reports and what that is.
Yeah.
So,
Yeah.
We've hammered this, but I'll hammer
okay.
it.
Yeah. Hammer it again.
So real estate and different real estate assets have a different format from an IRS regulatory standpoint, where depending on the improvements on the dirt, so the real estate's the dirt, and then you have improvements. Mobile home parks are really a real estate asset where you're owning the dirt, the real estate, and infrastructure. Well, infrastructure is technically mechanical. So when it's mechanical by nature, you're gonna have a cost segregation study done, and the IRS allows mechanical functioning parts and infrastructure to be depreciated on under 15-year depreciable basis. So in broad strokes, mobile home parks are typically 80% of purchase price you're allocating to the infrastructure, which is therefore under 15-year depreciable. And then something like a multifamily or industrial building, you have significant ownership of improvements that are concrete, steel, wood, stucco, you name all of the parts of a multifamily asset. And so you end up having a serious percentage, like 70% above the 15-year, in between 15 and like 27 or 30-year schedules, and then only 30% of the purchase price is under 15-year. So it's just an allocation game of the cost segregation study per the way that you are able to
spread out the
costs on the amortized schedule.
And mobile home parks are unique because when you do a cost segregation report, 80% of the total value, like if you're going to buy a property for $10 million,
Right.
typically 80% of the purchase price falls under that 15-year mechanical, because it's infrastructure, meaning roads, underground piping, things of that nature. That's mechanical.
We just double whammied that.
Yeah. Sorry.
But like, it's totally common sense, right? You buy a multifamily deal, it's one giant building. You buy a trailer park, we don't
It's
own the
land.
homes, right? We own the land. You're renting the land. So it totally makes sense that a cost seg would do that.
And then let's just run the math really quick, because someone says, okay, Ben, 80% you just told me, Blake, times 100 is 80. You just told me if I invest $1 million, I get $1 million on losses.
Right.
How
The
does
catch
that
is
work?
We're not raising. Yeah.
You add mortgage or leverage or debt, whatever word you want to pick, onto the property. So say if you buy,
I got a good one after this.
yeah, okay, I'm ready for it. say you buy $1 million asset and you put a 50% loan to value on it. For $500,000, you own $1 million property. So that's how you can get more losses than equity you put in, is because you're buying more purchase price than equity you're putting in through debt.
So yeah, let's break it down. I'll do a clean example of an apartment deal in a mobile home park. $10 million purchase price on a mobile home park. 80% or $8 million is towards the under 15-year bucket. So right now that like with the bonus, we have to also disclose.
Assuming that the 100%
with the bonus
is back
depreciation
in play.
for 100% of these types of assets.
Which hasn't passed yet.
Hasn't passed
it's at
yet.
40% currently.
So as I'm going through this, I'm like, well, technically it's not yet, but it's close.
Yeah.
So anyways, 8 million at that moment, when you buy that asset, 8 million, doesn't matter how you bought it, how much loan proceeds there were, whatever. It just is the purchase price of the real estate. And it's 10 million in this hypothetical, and then $8 million is under 15 year. Okay. So you have $8 million of, in this case, bonus depreciation in year one. So then you divvy that up. Well, the investors, let's just say we get a 50% loan to value, $5 million of cash, $5 million of loan proceeds. So now you have 8 million of loss to offset 5 million. And so how it works is it just goes to that 5 million and then pro rata share the owners from there. And it's
the 3 million remaining.
Correct.
In that
because it first
hypothetical.
goes to the equity and the cash.
100%.
So all of us would get full coverage, 100%.
Which is how they're getting 1-to-1.
Why Ben's saying, if you put in $1 million, you get $1 million. Okay. But then with this bonus coming back into play, what we're saying is it could go into another like 20 to 30%. You might end up with 1.2, 1.3 worth of loss on a given deal. And so that's really like the goal. I'd call it the hidden secret of mobile home parks. I mean, I bumped into a guy where he literally thought it was a secret, He's like, wait, everyone knows this? Like, I thought it was a secret. And that was real life. So then you have an apartment deal. Okay. Same thing. $10 million apartment deal. You same scenario, 50% leverage, 50% cash. So you have 30% under 15 year. So that's 3 million. So now you're only on your $5 million of equity, you're only going to offset 3 million. All 3 million goes to the cash investors in that case. And so you're limited to, what is that? 60%, 65%. Mm-hmm. And so that's like just down and dirty, the quick example. So on a bonus year, like for the next 5 years, if it passes, we'll have 5 years where we're double the amount of depreciation, which means the double the amount of tax savings on a given 100K or a given million. And then our IRRs and our returns, I'd say, are strong multifamily returns.
Definitely.
Like if you're buying core assets in multi, we're probably a nudge above on returns. Yeah. So now you get more tax benefits and more just all around appreciation and cash flow.
So what do you guys think? I think we should touch on also, like, if somebody was not able to qualify for the real estate professional election, can they, like, it's our understanding that they can still take advantage of these losses, not to the extent that we've been talking about in the last few minutes, but Ben, explain how that would happen.
Yeah. So it's not, if you don't have to be a real estate professional for this to make sense. Right. It's just, that is kind of like we're going in tax planning 3.0, but let's just say, hey, I want to invest.
Tax planning 1.0. Let's go back to that for just a second.
So
let's go to Connect 4 version.
Yeah. I like that. Yeah. If you just invest in mobile home parks, so you're not a real estate professional,
and
why
you're a
would you do that?
W-2 earner that has extra cash that you want to invest in real estate. What does that look like?
Yeah. The reason why you would do it is, one, for the returns, right? The stability of the returns. To Blake just pointed out, it's like you can invest in a bond or the stock market, right? And you can get a return, but anything that any of the income that it comes off, whether it's a bond, it's interest income, whether it's a stock, it's a dividend yield or dividend income, you're paying taxes on that. Mm-hmm. So if you're in a bond, let's just say like a CD, right? And it's giving you a 5%, you're going to go pay taxes on that 5%. So you're not actually clipping a 5%, you're clipping 3.5%, right? Maybe 4%.
Yeah.
And in real estate, you utilize the depreciation. You're not going to utilize all million in our example, right? But you're going to utilize that depreciation to wash all the income that piece of real estate produces. So you will pay virtually no tax on the income. And really the way you look at this is a deferral game. And I think we should carry this forward and talk about 1031 exchange strategies.
Yeah. I think another way to say it too is, from a tax perspective, it's a return of your capital instead of a return on your capital.
Yep.
When you get a distribution or a cash flow dividend from a real estate investment that we're doing versus a bond or treasury or something like that.
All right. If you're enjoying this content, hit the subscribe button and turn on notifications, and check out the description below for our websites listed. Thanks a lot for joining.